What if AI could see the next global financial crisis before anyone else? It could detect the warning signs months in advance. But what happens when the machine is wrong?
What if the next global financial crisis didn't surprise us? What if an artificial intelligence system detected the warning signs months before banks, investors, and governments realized what was happening? Imagine an AI watching the entire global economy in real time. It monitors stock markets, interest rates, housing prices, corporate debt, government spending, banking activity, consumer behavior, currency movements, commodity prices, international trade, and millions of other economic signals. Then one day, it notices something unusual. A combination of rising debt, weakening demand, excessive borrowing, falling liquidity, and growing financial stress. The AI calculates that the probability of a major economic disruption is increasing, and it sends one message: a financial crisis may be coming. But would anyone believe it? And even more importantly, could the AI actually be right? This is one of the most fascinating questions at the intersection of artificial intelligence and finance. Because predicting a financial crisis isn't simply about looking at a stock chart. Financial crises are complex events created by thousands of connected decisions. Banks lend money, businesses borrow, consumers spend, investors speculate, governments respond. Central banks change interest rates, currencies move, markets react, and all of these events influence one another. A small problem in one part of the financial system can sometimes spread across the entire economy. So could AI detect these connections before humans do? To understand that possibility, we first need to understand what makes financial crises so difficult to predict. A financial crisis often doesn't begin with one obvious event. Instead, problems can build slowly beneath the surface. Debt accumulates, asset prices rise, investors become increasingly confident, banks increase lending, businesses take on more obligations, consumers borrow more money. Everyone begins to believe that good times will continue. Then something changes. Interest rates rise. Property prices fall. A major company fails. A bank experiences losses. A currency comes under pressure, or investors simply lose confidence. Suddenly, people begin selling assets. Banks become more cautious. Businesses delay investment. Consumers reduce spending. Investors demand liquidity. And what started as a relatively small problem can spread through the financial system. This is where artificial intelligence becomes extremely interesting. AI can process enormous amounts of information at incredible speed. A human analyst might study dozens or hundreds of economic indicators. An AI system could potentially monitor thousands or even millions. It can continuously compare information from different markets and search for relationships that would be difficult for humans to identify manually. Imagine an AI monitoring housing markets around the world. It notices that property prices are rising rapidly. At the same time, household debt is increasing. Mortgage payments are becoming more expensive. Interest rates are rising. Banks are becoming more exposed to property loans, and household savings are declining. Each individual signal might not be enough to cause alarm, but together, they could form a much more important pattern. An AI could potentially identify that combination much faster than a human analyst working through separate reports. This is one of the major advantages of machine intelligence. AI can search through enormous amounts of data without becoming tired. It can compare current conditions with historical periods. It can detect unusual behavior. It can identify relationships between seemingly unrelated events. And it can continuously update its assessment as new information arrives. But there is a major problem. History doesn't repeat itself perfectly. The economy today is not the economy of 10 years ago. The financial system changes. Technology changes. Regulations change. Consumer behavior changes. And the next crisis may look completely different from previous crises. This means AI cannot simply search for an identical historical pattern. It needs to understand the relationships between different parts of the economy. Consider the global banking system. Banks are connected through loans, investments, payment networks, derivatives, and financial markets. A bank in one country can have exposure to companies or institutions in another country. An investment fund can hold assets across multiple markets. A financial institution can depend on short-term funding from another institution. The global financial system is therefore more like a giant network than a collection of independent businesses. And networks are exactly the kind of systems AI can analyze. Imagine thousands of financial institutions represented as points on a digital map. Lines connect them based on loans, investments, transactions, and other financial relationships. An AI watches the network continuously. Then one institution begins experiencing financial stress. The AI examines its connections. It asks, which institutions are exposed? Which markets could be affected? Which companies depend on this institution? How quickly could the problem spread? And where would the next pressure appear? This is the idea of systemic risk. The danger isn't always that one company fails. The bigger danger is that the failure creates problems for other companies, which create problems for others, and the chain continues. AI could potentially help identify these connections. But detecting risk is not the same as predicting a crisis. That distinction is extremely important. Suppose an AI identifies 10 warning signals. It doesn't automatically mean a crisis will happen. Financial systems can adapt. Governments can intervene. Central banks can change policy. Banks can raise capital. Companies can reduce spending. Investors can change their behavior. The system can correct itself. This creates one of the biggest challenges for economic AI. The economy isn't a machine following fixed rules. It is a collection of people making decisions. And people can change their behavior when they receive new information. Imagine an AI predicts that a particular housing market is becoming dangerously overvalued. The prediction becomes public. Investors panic. They begin selling. Prices fall. The AI's prediction appears to be correct. But why did the crash happen? Because the AI predicted it, or because people reacted to the prediction? This creates a feedback loop. The prediction itself can influence the system being predicted. And this could become extremely important in an AI-driven financial world. Now imagine millions of investors using AI. Every investor has access to an intelligent financial assistant. Every bank has an AI risk management system. Every major investment fund uses advanced algorithms. Governments have economic forecasting systems. Companies use AI to manage finances. At first, this sounds like a massive improvement. Everyone has better information. Everyone can react faster. Everyone can make more informed decisions. But there is a hidden problem. If everyone uses similar AI systems, they may make similar decisions. And when millions of systems react to the same signal at the same time, their combined actions could create a much larger market movement. Imagine an AI system detects increasing financial risk. It recommends reducing exposure. Millions of other systems receive similar signals. They also begin reducing exposure. Assets are sold. Prices fall. Other AI systems see falling prices. They interpret the decline as another warning signal. They sell more. The process continues. The AI successfully detected a risk, but the response to the warning may have amplified the problem. This creates a fascinating paradox. Could AI help prevent a financial crisis? Absolutely. But could widespread AI adoption also make markets more synchronized and potentially more unstable? Possibly. This is why the future of AI in finance isn't simply about prediction, it's about interaction. AI systems will interact with markets. Markets will react to AI decisions, and AI systems will react to those market reactions. The entire system becomes dynamic. Now consider another major source of financial instability: debt. Debt isn't automatically bad. Borrowing allows businesses to expand. Consumers can purchase homes. Governments can fund infrastructure. Companies can invest before they have enough cash available. Debt can help an economy grow. The problem appears when debt becomes excessive. Imagine an economy where companies borrow aggressively because interest rates are low. Investors become comfortable with risk. Banks are willing to lend. Asset prices rise. Everyone feels confident, but eventually, borrowing becomes harder to sustain. Interest rates increase. Companies must make larger payments. Some businesses struggle. Defaults begin rising. Banks become nervous. Credit becomes more expensive. And suddenly, the system begins moving in the opposite direction. An AI could monitor these changes continuously. It could analyze corporate balance sheets, borrowing patterns, loan quality, interest expenses, and repayment behavior. It could potentially identify when a particular sector is becoming dangerously dependent on cheap credit. The same approach could be applied to households. If household debt rises rapidly while incomes remain relatively weak, an AI might detect increasing vulnerability. If property prices also rise dramatically, the risk could become even more significant. Again, none of these signals guarantees a crisis. But together, they could create a warning system. And that may be where AI has its greatest value. Not necessarily predicting the exact date of a crash, but identifying conditions under which the financial system becomes fragile. Think of it like a smoke detector. A smoke detector doesn't need to predict exactly when a house will burn down. It simply needs to detect dangerous conditions early enough for people to act. AI could potentially become something similar for the global economy. A financial smoke detector, continuously watching for unusual signals. But economic prediction is harder than detecting smoke. The economy is influenced by politics, psychology, technology, natural disasters, wars, consumer confidence, and unexpected innovations. A sudden geopolitical event can change energy prices. A technological breakthrough can destroy one business model and create another. A government can suddenly change regulations. A central bank can change its policy. Consumers can suddenly become pessimistic, and investor sentiment can change within hours. These events are difficult to predict because they involve human decisions. This means AI should never be treated as a perfect financial crystal ball. Even an extremely advanced system would operate with incomplete information. Some data is delayed. Some data is inaccurate. Some important information is private. And some future events simply cannot be predicted. There is another problem: false alarms. Imagine an AI warns that a major financial crisis is likely. Governments respond aggressively. Banks tighten lending. Businesses delay investment. Investors sell risky assets. Consumers become nervous. Economic activity slows. The AI's warning becomes part of the cause of the slowdown. This is another feedback loop. A system designed to prevent a crisis could potentially create unnecessary fear. That means any AI used for financial forecasting would need to communicate uncertainty carefully. Instead of saying, "A financial crisis will happen," it might say, "Several indicators suggest that systemic financial risk is significantly elevated." That distinction matters. Financial markets react to language. A single statement from a central bank can move markets. Imagine if the statement came from a highly trusted artificial intelligence system monitoring the entire global economy. The consequences could be enormous. Now we reach another major question. Who should control such an AI? Should governments operate it? Should central banks operate it? Should international institutions operate it? Should private companies build the models? Should banks have access? Should ordinary investors have access? And should everyone receive exactly the same information? These aren't purely technical questions. They involve power. If one organization has access to a much better economic forecasting system than everyone else, it could gain an enormous advantage. Imagine a private financial institution discovering that a major market is becoming unstable before everyone else knows. That information could be extremely valuable. It could change investment decisions. It could change lending. It could change capital allocation. And it could potentially create an even greater gap between large financial institutions and smaller investors. But there is another possible future. AI could become cheap and accessible enough that advanced economic analysis is available to almost everyone. A small business could use AI to monitor economic risks. A local bank could use it to analyze loan portfolios. An individual could use an AI assistant to understand economic conditions. A developing country could use AI to monitor vulnerabilities in its banking system. In that scenario, AI could democratize access to financial intelligence. So AI could increase financial inequality, or it could reduce it. The outcome depends heavily on who gets access to the technology. Now imagine AI being used by central banks. Central banks already monitor enormous amounts of economic information. Inflation, employment, consumer spending, credit growth, interest rates, banking activity, international trade, currency movements. AI could potentially analyze these signals continuously. Instead of relying mainly on periodic reports, policymakers could have constantly updated assessments of economic conditions. They could simulate thousands of possible scenarios. What happens if interest rates rise? What happens if unemployment increases? What happens if energy prices suddenly spike? What happens if a major bank fails? What happens if a country's currency rapidly loses value? What happens if consumers suddenly stop spending? An AI system could potentially simulate these situations and estimate how different parts of the economy might respond. This could give policymakers something incredibly valuable: preparation. But there is a danger. Models can influence decisions. If policymakers rely too heavily on a single AI system, they may ignore information outside the model. This is known as model risk. A sophisticated AI can still be wrong, and if everyone trusts the same model, being wrong can become much more dangerous. Imagine every major bank using the same AI risk model. The model detects a potential crisis. Every bank receives the same warning. Every bank reduces lending. Every bank sells similar assets. Every bank increases cash reserves. The financial system suddenly becomes synchronized. The very model designed to protect the system could contribute to a sharp contraction. This is why diversity of analysis could become extremely important. Different institutions may need different models, different assumptions, different data sets, different risk assessments. AI should probably be treated as one powerful tool among many, not the final authority. Another challenge is transparency. Many advanced AI systems can be difficult to interpret. A model might identify an elevated risk without being able to explain the reasoning in a way humans can easily understand. Imagine a central bank asking, "Why does your system believe a crisis is becoming more likely?" The AI responds with thousands of statistical relationships. But which ones actually matter? Which are causal? Which are simply correlated? And how confident is the system? These questions become extremely important when the consequences involve millions of people. A financial AI shouldn't simply provide predictions. It needs to provide enough evidence for humans to evaluate those predictions. This is especially important when the system is wrong, because every economic prediction contains uncertainty. Now, let's imagine the future. It is the year 2040. AI systems are deeply integrated into the global financial system. Major banks have autonomous risk management agents. Investment firms have AI portfolio managers. Governments have economic simulation systems. Companies have AI financial officers. Individuals have personal financial agents. These systems continuously communicate. The global economy is being monitored every second. Then a financial vulnerability begins developing in one region. An AI notices unusual borrowing behavior. It compares the pattern with historical data. It identifies increasing exposure among several banks. Other AI systems independently detect similar signals. A global risk network begins showing rising stress. Instead of waiting for a crisis, regulators receive an early warning. Banks increase liquidity. Companies reduce risky borrowing. Investors rebalance portfolios. Governments prepare emergency measures. The vulnerability is addressed. The crisis never happens. If this becomes possible, AI could become one of the most powerful tools ever created for financial stability. But imagine the opposite. The AI makes a mistake. It interprets normal market activity as a major threat. Financial institutions react. Investors sell. Banks become cautious. Businesses reduce investment. The economy slows. The AI sees the slowdown. It interprets the slowdown as confirmation. Its warnings become stronger. More institutions react. The system creates the very crisis it was designed to prevent. This demonstrates the central challenge. AI isn't outside the economy. It becomes part of the economy. Once AI begins making financial decisions, its predictions influence the very system it is trying to predict. That makes economic forecasting fundamentally different from many other prediction problems. You aren't predicting a passive environment. You're predicting a system that reacts to predictions. And that could be the biggest limitation of AI financial forecasting. Still, the potential is enormous. The global economy generates an incredible amount of information every second. Transactions, prices, loans, payments, trade, news, consumer activity, supply chains, investment flows. AI can potentially process all of this continuously. Humans can then use that intelligence to make better decisions. That may be the most realistic future. Not AI replacing economists. Not AI replacing central bankers. Not AI becoming an all-powerful financial oracle. But AI becoming an extremely powerful early warning system. A second set of eyes watching the global economy. A system capable of asking, what changed? Why did it change? Where could the pressure spread? What happens if this trend continues? And what could we do about it? The value of AI may therefore be less about predicting the exact day of a crisis, and more about identifying the conditions that make a crisis more likely. That distinction could completely change financial risk management. Instead of reacting to crises after they happen, policymakers could become more proactive. Instead of discovering problems after banks fail, regulators could identify vulnerabilities earlier. Instead of waiting for markets to panic, institutions could monitor the signals that often appear before panic. AI could potentially transform financial risk management from a reactive process into a continuous process. But we should never forget something important. Financial markets are ultimately built around human behavior. Humans take risks. Humans become confident. Humans become afraid. Humans panic. Humans change their expectations. Humans innovate. And humans sometimes behave in ways that no model expects. The future, therefore, will never be completely predictable. No matter how advanced AI becomes, there will always be uncertainty. There will always be surprises, and there will always be events that nobody saw coming. So could AI predict the next global financial crisis? It may never be able to predict one with absolute certainty, but it could potentially detect warning signs earlier. It could identify hidden financial connections. It could monitor systemic risk. It could simulate possible outcomes. And it could give humans something extremely valuable: time. The biggest breakthrough may not be an AI that says, the crisis will happen on this exact date. It may be an AI that says, something is changing. These systems are becoming increasingly connected. Risk is rising. And if these trends continue, the consequences could become serious. That kind of intelligence could be incredibly valuable. But it would also come with enormous responsibility. The systems need transparency. They need independent testing. They need reliable data. They need diverse perspectives. They need human oversight. And perhaps most importantly, they need humility. An AI should never be treated as an oracle. It should be treated as a powerful analytical tool. Because predicting the future of an economy isn't the same as predicting the movement of a machine. The economy is constantly changing. It reacts. It adapts. It learns. And increasingly, it may learn through artificial intelligence. So perhaps the real question isn't, can AI predict the next global financial crisis? Perhaps the real question is, Can humans use AI well enough to recognize danger before it becomes a disaster? That may determine whether AI becomes one of the greatest tools for financial stability, or another source of systemic risk. The next financial crisis could begin with a bank. It could begin with a housing market. It could begin with excessive corporate debt. It could begin with a sudden geopolitical shock. It could begin with a collapse in consumer confidence. Or it could begin somewhere nobody is currently watching. We don't know. But for the first time in history, we are developing machines capable of watching almost everything at once. They can analyze markets around the world. They can connect financial signals. They can detect unusual behavior. They can simulate thousands of scenarios. And they can alert humans before warning signs become obvious. Whether that will be enough to prevent the next crisis remains unknown. But one thing is certain: the future of finance will not simply be about predicting markets. It will be about understanding increasingly complex systems and deciding how much of that understanding we are willing to trust to machines. Because if AI can see the next crisis coming, the most important question won't be whether the machine was right. It will be whether humanity listened in time.